One of the biggest challenges that investors face is managing their emotions and avoiding panic selling or buying during market fluctuations. Emotions can cloud your judgment and lead you to make irrational decisions that can hurt your long-term returns. In this section, we will discuss some tips and strategies on how to manage your emotions and stay calm and profitable in the stock market. First, you need to create personal rules that you can follow when you trade. These rules can help you control your emotions and stick to your plan. For example, you can set risk-reward tolerance levels for entering and exiting trades through profit targets and/or stop losses. You can also set a limit on how much money you are willing to lose or gain in a day, week, or month. By having these rules, you can avoid being swayed by greed or fear and act based on logic and discipline. Second, you need to trade the right market conditions that suit your style and strategy. Not every market environment is ideal for every investor. Some investors prefer to trade in trending markets, while others prefer to trade in ranging markets. Some investors like to trade in volatile markets, while others like to trade in calm markets. By knowing your strengths and weaknesses, you can avoid trading in situations that are unfavorable or stressful for you. Third, you need to lower your trade size if you feel anxious or nervous about your positions. Trading with too much money can amplify your emotions and make you more prone to overreacting or making mistakes. By reducing your trade size, you can reduce your emotional attachment and pressure and focus more on the quality of your trades rather than the quantity. Fourth, you need to establish a trading plan and a trading journal that can help you track your performance and learn from your mistakes. A trading plan is a document that outlines your goals, strategies, risk management, and criteria for entering and exiting trades. A trading journal is a record of your trades that includes the date, time, price, volume, reason, outcome, and emotions involved. By having a trading plan and a trading journal, you can review your trades objectively and identify what works and what doesn't. You can also use them as tools to improve your skills and confidence. Fifth, you need to relax and take care of your physical and mental health. Trading can be stressful and exhausting, especially during market fluctuations. If you don't take care of yourself, you can burn out and lose motivation and focus. Therefore, you need to take breaks from the market regularly and do things that make you happy and relaxed. You can also practice meditation, yoga, breathing exercises, or other techniques that can help you calm your mind and body. By following these tips and strategies, you can manage your emotions better and avoid panic selling or buying during market fluctuations. Remember that emotions are natural and inevitable, but they don't have to control your actions. You can use them as signals rather than drivers of your decisions. By doing so, you can stay calm and profitable in the stock market. One of the most important skills for any investor is how to diversify your portfolio and use risk management strategies to protect your profits. Diversification means owning a mix of investments within and across different asset classes, such as stocks, bonds, commodities, real estate, and alternative investments. The goal of diversification is to reduce your exposure to risk and volatility, which means the chances and extent of losing money when some of your investments underperform. To build a diversified portfolio, you need to consider three factors: your risk tolerance, your time horizon, and your investing goals. Your risk tolerance is how much risk you are willing and able to take with your money. Your time horizon is how long you plan to keep your money invested before you need it for a specific purpose. And your investing goals are what you want to achieve with your money, such as retirement, education, or wealth creation. Based on these factors, you can choose the right mix of assets for your portfolio. For example, if you have a high risk tolerance, a long time horizon, and an aggressive goal, you may want to allocate more of your portfolio to stocks, which have higher returns but also higher volatility. On the other hand, if you have a low risk tolerance, a short time horizon, and a conservative goal, you may want to allocate more of your portfolio to bonds, which have lower returns but also lower volatility. Another way to diversify your portfolio is to invest in different types of stocks and bonds within each asset class. For example, you can invest in large cap and small cap stocks, growth and value stocks, domestic and international stocks, corporate and government bonds, short-term and long-term bonds, and so on. This way, you can benefit from the performance of different sectors, industries, regions, and market conditions. A third way to diversify your portfolio is to explore alternative investments that are not correlated with the stock and bond markets. These include commodities like gold and oil, real estate investment trusts, REITs, hedge funds, private equity funds, and cryptocurrencies. These investments can offer higher returns or lower risk than traditional assets, but they also come with their own challenges and risks. Therefore, you should only invest in them if you understand how they work and how they fit into your overall portfolio. Diversifying your portfolio is not a one-time event. You need to monitor and rebalance your portfolio regularly to make sure it stays aligned with your risk tolerance, time horizon, and investing goals. Rebalancing means adjusting the weights of your assets according to their performance and market conditions. For example, if stocks have done well and bonds have done poorly in a given period, you may want to sell some of your stocks and buy some more bonds to bring your portfolio back to its original allocation. This way, you can lock in some of your gains and avoid being overexposed to one asset class. Diversification is not a guarantee against losses or a shortcut to success. It is simply a technique that can help you reduce risk and smooth out the ups and downs of investing. By diversifying your portfolio and using risk management strategies such as rebalancing, you can increase your chances of achieving your long-term financial goals.